Okay, Alaki, let's solve this past exam question, Chimura company. So in this question, we have to make a report. For report, follow the simple format report, heading report to from subject date introduction and in the end write conclusion or recommendation. So I will recommend you write all this in word processor and calculation part you do it in Excel, right? So in this question, we have to prepare and evaluate report for board of director of Chimura company, which addresses the following parts and recommend an appropriate course of action. So first part is basically we have to consider without the offer. So there is some offer by a company. We don't have to consider that offer and do our calculation. So that part we are going to discuss today. The second part we will not do because it requires knowledge of Black's call option pricing model. And the third part is the assumptions you made in part one and part two, you have to write in plus additional business risks. Okay, let's start the question. It says Chimura company, since becoming an independent just over 20 years ago, the country of Megam has adopted protection measures which have made it difficult for multinational companies to trade there. However, recently, after discussion with World Trade Organization, it seemed likely that Megam will reduce its protection measures significantly. Okay, so it's a good news for us. Encouraged by this discussion, Chimura company, a company producing packaged food, is considering a project to set up a manufacturing base in Megam to sell food there in other regional country nearby. So we know that this is a typical question of where one company is opening a branch in a different country, international investment appraisal. Our initial investigation costing 5 lakh established that Megam had appropriate manufacturing policy. So we know this is in sunk cost. It is irrelevant for the decision making, right? It has already incurred. The investigation concluded that if the protection measure were reduced, then the demand potential for Chimura company product looked promising. It is also felt that early entry in Megam would give Chimura company an advantage over its competitor for a period of 5 years. Okay. So duration of the project is 5, after which current project will see due to development of new advanced manufacturing process. Okay. So currency in Megam is pesos, Megam pesos, MP. Is currently trading MP 72 per dollar. So $1 is 72. So current spot rate is given. So using this, we can calculate exchange rates if interest rate or inflation are given to us. Setting up manufacturing base in Megam will require initial investment of MP 2,500 million. So we have to solve this question in million, all of you, because why million figures are already quite big. So you don't have to convert in thousand. Million figures are sufficient for calculation. So MP 2,500 million immediately to cover the cost of land and building. 1 to 50 million for land building and 50% for machinery. Okay. Tax liable depreciation is available on machinery, only on machinery. Okay. No depreciation is allowed on building at the rate of 10% on SLM. A balancing adjustment will be required at the end of 5 when is expected machinery sold for 500. So balancing charge, balancing allowance is required. The market value of land building is estimated 80% of current value, inclusive of tax impact. So you don't have to consider any tax impact. Now this is the part which is we require to start the question. Chimura will require MP 200 million for working capital immediately. It is not expected any further injection. So very simple. Just input the working capital at T0 and reversal it. End of project. That is 5th year. Production of the packaged food will take place in batches of product mixes. These batches will then be sold in the supermarket chain. Wholesaler, distributor, Megam and its neighboring country will repackage them to their individual requirement. All sales will be in MP. The estimated average number of batches produced are given below. Batches produced and sold are given below. Okay. The current selling price for each batch is estimated to be MP 115200. Okay. These costs related to producing and selling each batch are currently estimated to be MP 46,500. In addition, the first year, before falling to 20% of these costs, excluding the cost of special packaging in the second year, and the nil for remaining year. It is expected that the cost leading to production sale for each batch will increase annually 10%, but the selling price and the special packaging cost will increase by 5%. Okay, a lot of data is given to us. So let's start solving this question. And then we'll read this remaining data along with solving. Okay. So let's solve. We are solving part B, first part, right? So we are in Megam, where currency is MP. We are doing question in millions. Let examiner know this. I will recommend you to write unit. Specifically, generally we start with year, but for this question, I will recommend you to write unit. You will see it will be frequently useful. Let's first write the year, then we will write the unit. 0, 1, 2, 3, 4, and 5. Let's also write the unit part. So in the first year, the units are 10,000, right? 10, 15, 30, 26, and 50. So 15,000 is the unit for second year. Then we have 30,000. This data will be frequently useful. So instead of typing again and again, let's make one time, let's write these data so we can use it again whenever required. Now let's talk about revenue. It says that one unit will be sold for 115200. 115200. So not an issue. Simply this multiply 115200, right? 115200. And inflation, selling price especially will only increase by 5%. Inflation of 5% is also good. Okay. So this multiply 115200 multiply 1.05 raised to the power because of inflation. And do remember to divide by 10 to the power 6 to convert in million. This is our revenue. That's why I told you to write. See how simple it becomes. Now you can simply run this formula and you will get your answer. Correct. After revenue, we have production cost, right? After revenue, we have production cost. Now, so let's see what question is saying about production cost. So cost related production selling is 46,500. So that is also given. Is there an inflation rate on the production cost? Have they given the production and sale of each bell increase annually by 10%? Okay, 10% increase they have given. So this multiply 46,500 multiply 1.1 raised to the power again 1 divide by 10 to the power 6. Put a negative sign at the start as it's a cost. Correct. Done with this part. Now, special packaging cost. Special packaging cost. Now, what they say about special, in addition to these costs, number of special packaging which Chmura will send to Mega, Chmura will send to Mega. So it's a special packaging which Chmura will send to Mega. Currently, the cost of special packaging material is 200 per batch. So it's 200 per batch. And they have given us that special packaging is also increasing at the rate of 5%. But for this special packaging, they have given us $200. So it's better we calculate exchange rates first. Let's make a working note. Calculation of exchange rates, right? So 2, 3, 4, and 5. because dollar and currently we are in pesos, megam pesos, so we have to convert it. So they have given us 72, right? They have given us $1 is 72 megam pesos. After this, we have to check the inflation rate. The data is going to see the risk-adjusted discount rate, the current inflation rate, Megam 8% and Chmura based in 2%. So purchasing power parity, we can apply this, multiply 1.08 inflation of quote currency divided by inflation of base currency. Now just run the formula. Got it. Special packaging cost. Understand here, special packaging cost. In addition to these costs, number of products will need a special packaging which Chimura company will send to Mega. So this is not a revenue of Chimura. Remember, they are just sending. They are buying for 200 per batch. So it's a cost directly. Chimura is not making any profit. They are paying $200, which is reimbursed by Mega. So it's ultimately the cost of Mega. Now it says there's inflation of 1.1. So negative. This multiply 200, multiply 1.1. So this will be your inflation rate. Sorry, inflation rate is not 1.1, it's 1.05. Let me correct it. But this answer is in dollar. Now, are we going to multiply or divide? We are going from dollar to megam pesos. We will multiply and divide by 10 to the power 10 to the power 6. Just one more correction. Let's also reference the inflation rate so we can run the exchange rate. Everything is done. Special packaging cost. After this training and development cost. How much is training and development cost? As 80% of production selling cost and falling to 20%. So very simple. 80% of production cost, then 20%, then 0. So what is our production cost? This minus production cost. Someone need to put minus already in negative, sorry. Multiply 0.8. This multiply 0.2. Then it says 0, and right. After this, is there any cost left? Training and development. Uh, no tax rate. So no cost. So final time for adjustment of tax allowable depreciation tag. Let's do the adjustment of that working note 2. So asset depreciation and carrying value. So I think the asset is of 1250, right? Depreciation they have given, I think, SLM method. Machine tax liable machine on 10% on SLM, right? So this at 10%. This 0.1, 1.25 is the depreciation. this minus this. You will run this, right? Till 4 year, this will work. But remember, in the final year, you will not charge depreciation. Instead, they have given you scrap value in the final year, 500 million pesos. You can see machine will be sold for 500 million after inflation. So inflation is also impacted. So there's a balancing charge or balancing allowance. Balancing allowance because there's a loss. So we will get 250 balancing allowance. So let's simply give the referencing here for the final year. Loss of 250 will generate tax saving. We will add back this balancing allowance, remember. So after adjusting that, now you can calculate taxable profit equal sum. Correct. Now just calculate tax. 25% is the tax. This is our tax. Now you will get the PAT, profit after tax, this plus this. So that's good. There is no tax losses. So add back debt. Even balancing allowance need to be added back because scrap value will be the inflow of scrap value will be considered in totality separately. So these are all cash flows, right? Now what we will do after adding back depreciation, now let's do the adjustment of other cash flows. I think now only working capital and initial investments are left. So initial investment, land and building. So there's a negative outflow of 1250. And finally, they are saying 80% of this value will be inflows. So uh, quite a major amount we are getting inflow back, 1000. Then machine, again, negative 1250 and inflow is 500. Let's hard code it. Yeah, right, 500. Correct. 500 machinery. Now, anything else left? Yes, working capital. So outflow negative 200. And then we have inflow at year end. Working capital is also done. Now simply calculate cash flow in megam pesos. Right now, this is your cash flow in megam pesos. Now, but we are not in megam now. We have to convert these cash flows in the dollar. We are operating from US. So we have to convert. Let's reference the exchange rate we calculated below. Remember, this time we will not multiply, we will divide to calculate cash flow in dollars. Smaller to bigger. You are now going from smaller currency to a bigger currency. So you have to divide. Let's divide 72, 37.5. You got cash flow in dollars. Right? Is it making sense? Now, do we have any other adjustments like in other portions? Do we have any royalty adjustment? No such royalty or anything adjustment is required here. Let's calculate the discount rate. Let's see whether discount rate is given or we have to calculate it using gearing and getting any concept. The risk-adjusted cost of applicable to the project in dollar-based cash flow is 12%, which is higher than the short-term treasury bill. So this is also given to us. One part we have are not discussing right now, which require knowledge of Bishop. Once we have discussed black spot option pricing model, that part you can do it on your own, it will become very easy. Like now simply calculate the NPV equals NPV. See, at first this question appears very daunting, but you can see how easy this question is. So NPV is negative. So prima facie we will reject this project. NPV of this project is negative. So we will reject this project. Right, all of you? So like this, you will solve investment appraisal questions on Excel, which makes this Excel thing, this platform makes the calculation part very easy. Just you have to follow the flow. Secondly, then we also have to write the assumption. So assumptions here, um, you can write about assumptions mainly the constant things which you have assumed to be constant, like inflation figure, cost of capital, and you can recommend some sensitivity analysis, scenario analysis. So detail you can read from the examiner, answer the additional business risk. So do practice more of such questions. So let's end our discussion for today, all of you. Take care. Bye bye, everyone.